voice of the day, and my colleague Nikunj is in conversation with none other than Ravi Dharamshi to get you a class in value investing. Nikunj.
Right, Tanveer, thanks a lot for that. So Ravi Dharamshi is back, and he's come back at an appropriate time when macros are shaky, Rupee is at 70, the market no longer are crying, and financial media, both locally and globally, we have stopped using words like rout in emerging markets, crack in small and mid-cap stocks, and a panic in some of the micro-cap stocks. So last time when we interacted with Ravi, markets are a bit shaky, but now they are looking much more stable. So welcome back. Thank you for joining us.
Thanks, Nikunj.
It's a good time to come back, right?
Yeah, of course. There's always much happening.
6.5% higher for the Nifty from the recent low. Small cap indices, which were down by about 15 to 18% from the YTD high, they've also recovered 50%. I wouldn't say awful has become great, but awful has certainly become bad for the Indian markets.
Yeah. Let me just give you a perspective of how we look at it. So the rally prior to in 2017 was actually a very polarized rally where very few stocks did well. So what we are witnessing now from this quarter result onwards is that actually the ocean, the breadth of the market, the companies that are doing slightly better than what they were doing earlier is actually increasing. So also the fact that mid cap, small cap saw a nice correction towards in the first half of this year helps the fact that now the value is also emerging, and the growth expectations have also aligned a little bit more to the reality. Earlier, the people are extrapolating much faster, and large caps were attractive relative to mid cap. I think now that's where the money is flowing incrementally.
So how would you characterize the current market behavior? Expensive market which got corrected and now it is back to basics, or expensive market which got corrected, has recovered and will fall again?
Okay, so there are multiple markets within this market. I mean, there is a mid-cap market which was getting very expensive and has corrected, and at the same time there's a large-cap market which was not very expensive, has to some extent that convergence has happened of valuation. So I won't categorize this market as extremely expensive, and neither are we leveraged. Whether it is the economic cycle, I think economic cycle is at the cusp of picking up. Leverage cycle is also on the cusp of picking up. I think we are going to witness some credit growth and leveraging of corporate cycle a year down the road when the capacity utilization for most companies pick up. So the capex will actually start happening within 2 years. I mean, I can't say whether it will happen 4 quarters from now or 8 quarters from now, but for sure it looks like we are reaching a stage from where the capex will pick up. So economic cycle is picking up, market is reasonable, not very expensive. When you look at 1 year forward, it's reasonable. There is headroom for growth, and barring a global crisis, I don't think we'll get too much of a better opportunity to invest. I mean, we can always correct 5-10%. That's not a consideration at all. I'm saying beyond that, expecting a major crisis at this point of time without anything major happening in the global, I don't think that's a scenario that's panning out at.
You know, historically it is believed that when there is weakness in the currency, that is an harbinger of weak economy, weak macros, and trouble for emerging markets. But in your latest tweet, you are perhaps proposing a different thesis, that in the short term there could be a sentimental correlation because of weakness in rupee, but in the long term, weakness in rupee is actually good news for India.
Yeah, so historically, if you were to directly correlate the markets and the rupee, it is not like rupee depreciation has led to markets falling. What matters is definitely the pace at which it is depreciating and the reasons for which it is depreciating. Right now we are depreciating because dollar index is getting stronger. Okay, incrementally our macros have also weakened a little bit, but it is not a situation. RBI is focused on inflation, government is focused on reviving the economy. I don't think, and we are not over leveraged or spread ourselves to think that we will be hit by something out of the blue. So if that is the scenario, then I don't think one should be overly duly worried about rupee crossing 70. I think those are all sentimental things and won't matter beyond a point. Rupee actually should depreciate. It is more a symptom of what is happening rather than it is causing something. So yeah, our incrementally our macros have weakened a little bit. Our current account deficit has widened. The fiscal deficit has been loosened a little bit, and that is what is getting reflected in the rupee. But we are not at 6.5% fiscal deficit. We are at 3.5%, and we will achieve those targets, give or take a little bit. So I am not overly concerned about rupee depreciation.
The first port of call with currency is that when rupee is strengthening, you buy importers. When rupee is weakening, you buy exporters, which is IT, pharma, select metal companies. Is the correlation that simple? Are you buying this so-called naive correlation?
No, so there is some benefit to the exporters that cannot be denied. If they were realizing 68 rupees for a dollar worth of sale, now they are going to get 70 rupees for the same. So you cannot say that some benefit is not flowing in. But is that leading to an incremental growth? Are you getting more competitive in the world? I doubt that a major structural shift will happen in the services that we are providing because our currency is depreciating. It is just incremental P&L benefit rather than a major demand shift to our country just because of rupee, singling out that factor alone.
2018 in a sense, spoilt us, and the reason why it spoilt us is because everything and anything went higher. The small cap index in dollar terms gave a return of 50% plus, actually 60% plus. But now do you think the differentiation has started and it will only expand more, where 80% of the market may not do anything, but 20% of the market will still go higher?
I think market, as much as some of the high-priced consumer stocks are scaring us, I believe market is actually in its senses right now. Only performing companies, growth companies, superior companies are getting higher valuations. Companies that are not performing or have some balance sheet issues or where the growth is not coming is actually those stocks are not doing very well. So that tells you that there is market is not completely nonsensical, where the risk is not getting priced. Having said that, am I buying any of those incremental consumer stocks? No, I'm also in the camp that one should be reducing from there, because there the valuation comfort is much less, and it's a hyper growth as well as accompanied by hyper valuations. So when the hyper growth phase ends, we have no idea when it ends, the valuations will come back to normalcy, and that can be a big jolt from the stock price point of view. So we are incrementally just aligning ourselves to a more reasonable valuation and a reasonable growth at this point of time, where the growth is likely to come maybe 12 months or 24 months down the line. And I think there are opportunities out there available in that space.
So let's revisit that thesis once again. Hyper growth, hyper valuation get replaced by reasonable growth and reasonable valuations.
Yes.
So let's discuss that once again.
Sure.
When you say hyper growth, are you referring to FMCG companies because they've given double-digit growths?
Correct.
Are you referring to companies like Page Industries and Jubilant Foods because they've given 30% growth? That's hyper growth.
That's precisely. Those are precisely hyper growth combined with fantastic quality of company are getting far superior valuations, rightly so. And as long as the growth continues, I don't see a derating at that point of time. But incrementally, investing in those names is an issue. So the last time we spoke about, I spoke about still sticking with the companies where the growth momentum is still there. But if that growth momentum has been extrapolated 2, 3, 4 years out and is, the price is capturing in, then I think one needs to be a little wary on that front. Within consumer space itself, there are enough companies where there's some or the other issues because of which they are not getting valued like that. And you can incrementally shift your portfolio towards those companies.
But when we have a large political event, which is now even less than 12 months away, some would argue that this market will remain volatile. Capex commitments may not go through. Entrepreneurs and promoters, they want to commit, but they may refrain from committing, which will delay both the demand cycle and the capex cycle. And because of pure uncertainty, defensives may still outperform.
Yeah, so that event providing enough uncertainty and a negative outcome can actually lead to a way better entry point than today. Can't rule that out, but there is no way. I mean, when a stock picker comes and talks about macros, be scared. I mean, I have absolutely no sense of how that event is going to pan out. And what I can do is position my portfolio to the economic cycle. And I believe whatever the outcome of that event, that economic cycle is unlikely to be derailed. What happened in 2004, even when the Vajpayee government lost, the economic cycle actually picked up in a big way post that. So can similar thing like that happen? I think it is possible, though I have no idea on the outcome, but I do believe that the economic cycle is just picking up and we are not done with the economic cycle. So that gives me a lot of comfort in staying invested. Can we have a tactical 10-20% kind of cash raise before the event? All that is possible, but at this point of time it's too early to think about it.
So you will not take the easy way out, which is that buy 2-3 NBFCs or the popular names like Bajaj Finance or you know, or let's say Bandhan or UF Finance, or maybe buy HUL or sit in Britannia. You will not go for the easy approach.
But that's not easy anymore. Everybody is there, so
Okay.
Definitely that's the difficult part. Now generating any kind of alpha, buying those stocks is next to
Are you
impossible.
selling consumer names in your portfolio?
So incrementally, as I told you, incrementally we are moving out of companies or stocks where the market has recognized the growth and is factoring in 2-3 years out. Those are the ones that we are incrementally selling and getting into names where market has doubt on FY19 numbers itself. So reasonable growth and reasonable valuations without any balance sheet issues. I think I would focus on those companies. So there are a lot of themes that are emerging, and nature of the market will change over the next 12-18 months.
So what are you buying right now?
So I think tactically, with a 3-4 year point of view, I think one should align themselves a little bit more towards the capex oriented. So whether you buy a corporate bank or whether you buy a product engineering company, so those are the kind of stocks where there has not been major wealth creation over the last 8-10 years, and I think those stocks can give meaningful return and generate meaningful alpha over the next 3 to 5 years. So I think we are aligning incrementally. It doesn't have to be overnight. I'm just saying that's where the puck is going to be 2-3 years from now, and my job is to look for companies in that space incrementally.
So when you say you're betting on capex,
She had